Last month, the Fed officially kicked off its interest rate cutting cycle. And the first cut was large, coming in at 50 basis points or a half a percentage point, kind of helping to get the ball rolling and allowing the Fed to make it clear that they're serious about cutting interest rates to help the underlying economy. So from here, we're sure to see traders react in a variety of different ways. The market's certainly going to ebb and flow on a day-to-day basis with a lot of different factors coming into play. But one thing that's important is that we're going to be looking at a different trading environment simply because interest rates are now on the path to going lower, and that'll be a path that will continue for some time. Rate cuts will benefit certain companies more than others and certainly put pressure on some companies that are going to find it more difficult to operate in today's market. So today I wanted to go ahead and talk about some winners and a potential loser from this interest rate cutting cycle. So on the winning side, we've got a couple areas that are going to do really well in the market. One area that I like a lot is utilities. And while some people think of utility stocks, meaning electricity, water, and other kind of normal services that are offered to consumers and businesses, a lot of people think of these stocks as boring. But in today's market, we're going to see a lot more action in utilities and a lot more potential for profits. One of my favorites is NextEra Energy, ticker NEE. So here's what's happening behind the scenes. Lower interest rates actually creates lower capital cost for data centers. So for these companies that are building huge servers and they need to borrow money to build these warehouses, to cool their servers, to put in the computing equipment that then winds up powering things like AI, cryptocurrencies, and many of the other really high-tech areas of the market that are very popular right now. So with lower interest rates, companies can borrow money and build more of these data centers. It also helps to lower cost for utilities who are building power plants and other big infrastructure projects that help provide power to these AI and other high-tech data centers. So as the lower rates kind of help to generate more business on that side of the market, it will certainly help raise profits for utility stocks. Remember, utilities, when they sell to residential customers, they are very regulated and they can't charge exorbitant prices. But things are very different when utilities sell power to large corporations. They can sell the power at a price that the market will bear, and so their profit margins wind up being much wider. So that's why in today's market, we're seeing these traditionally boring stocks actually become very exciting because they are generating higher profits directly from these data centers and other really high-tech consumers. Another reason that low interest rates helps these stocks is that low interest rate actually drive capital from other areas of the economy and other areas of the market to dividend stocks. Here's what's happening. A lot of institutional investors have money in other areas of the market, such as money market funds and things that generate income because of the higher interest rates that we've had in the past, over the past few years. So as interest rates now drop, there's an incentive for those investors to move money out of these safe areas of the market and into other stocks and other areas that will generate income. So because utilities like NextEra Energy pay dividends, there is an incentive for capital to move into those stocks and to drive those stock prices higher. NextEra Energy currently pays a 2.6% yield, and that should grow because the company's profits are expected to rise thanks to these strong business dynamics. And so as we see those profits rise, as we see more income paying to NextEra Energy customers, and as we see capital moving into that area of the market, it should benefit us as investors. Another area is consumer staples. So think about companies that sell goods and services to, or traditionally goods, to customers, and these are goods that you'll buy no matter what, whether you have a job or not, whether you have extra spending money or not. You're going to buy some of the traditional basics that you would always buy no matter what. One company that benefits from this type of spending is Coca-Cola, ticker KO. Coca-Cola is a lower priced or offers kind of lower priced discretionary goods that you don't have to buy a Coke, but if you don't have as much money that you could spend on a big trip or some other big expenditure, you might spend that money on a Coke for your kid and just have a good afternoon out. So Coca-Cola, their revenue is traditionally very sticky, no pun intended, and they will continue to make money in good times and bad. Another benefit to Coca-Cola is that lower interest rates here in the United States tend to decrease the value of the dollar compared to other currencies. So if the US dollar has lower interest rate, international investors will move money out of the dollar and into other areas of the market, other international areas of the market. When the dollar is lower and other currencies like the euro or the yen or the Chinese yuan or other currencies kind of appreciate compared to the dollar, it means that companies like Coca-Cola that sell internationally can actually generate higher profits from those international markets when they generate, let's say, a profit in euros. When those are translated back into weak dollars, it means that you're making more in dollar terms for profits. So that helps to boost the stock price because the company's dollar earnings are increasing. So that's another benefit to a big international consumer staples company like Coca-Cola. Coke offers a 2.8% dividend yield. And again, these are stocks that I'm expecting those yields to increase because as the company's profits grow over time, these companies tend to increase their dividends like clockwork every single year. So once again, that's Coca-Cola, ticker KO. And then as far as losers are concerned, consumer lending companies tend to do poorly when interest rates are decreased. And that's because they can't charge exorbitant interest rates when they lend money to consumers. Now, we're in a special part of the cycle right now that could be dangerous for these consumers because lower end consumers are struggling. The job market has been ebbing and flowing. We have seen that lower income jobs have been pressured, and individuals and families who are struggling with inflation just don't have as much spending power, and they are starting to fall behind on credit cards, on auto payments, and on other consumer lending, just being able to service those interest costs. One of the companies that's in this category is Ally Financial, ticker ALY. Ally has already extended loans to struggling consumers. So they've already got a lot of leverage out there where they have loaned money, especially for auto loans, and those loans are starting to run into trouble. So we're starting to see delinquencies and even defaults, which will hurt Ally Financial's underlying book of business. At the same time, the company cannot issue new loans at high rates because rates are coming down. So each new loan that they offer will be a little bit less profitable. So it's a challenging environment for Ally Financial, and I do expect that stock to trade down. If it's in your portfolio right now, I would consider selling it or doing some sort of risk management strategy to keep you from losing money if that stock trades lower. All right, that's it for today. I hope you found my insights helpful and informative, and I'd love to hear what you think as well. So please leave a comment on this video. Let me know what you think. If you agree, if you disagree, or just simply if you have a thought. Here's to building and protecting your wealth.